Welcome to Retirement Decoded with your host, Scott Tucker, where we break down the complexities of retirement planning to give you clear, actionable advice. Whether you're just starting out or getting ready to retire, Scott's here to help you make informed decisions and secure your financial future. Tune in each week as we simplify the process and decode the path to a stress-free retirement. Now, here's your host, Scott Tucker.
Welcome back to the podcast, Retirement Decoded with Scott Tucker. I'm your host, Scott Tucker. My trusty sidekick, as most of the time, is Associate Advisor Andre Hootie. Say hello, Andre Hootie.
Hello, Andre Hootie.
Andre Hootie, today's question comes from Margie. And Margie says, Scott and Andre, I'm looking for ideas of what you would do. My husband is inheriting about $500,000. It is due to roll in over the next few months. We just need to park it for several months until the dust settles with our lives right now. And I'll stop there. There's more to this question/statement. So, Andre, Margie and her husband, they're looking for ideas on what we would do if we were in Margie's shoes and her husband's shoes. Her husband's inheriting $500,000, and she says it's due to roll in over the next few months. She didn't say roll over. She didn't say what the tax treatment is. It's going to roll in. It almost sounds to me, I got to read in the tea leaves, Margie, because we're not able to talk to you just now. This is a written question. It sounds like, Andre, it might be settlement from an estate. It sounds like it might be non-qualified money, not IRA money.
That's kind of the feeling I got too. But that was going to be my first question, so you beat me to it.
Yeah, what's the tax treatment of the money?
Yeah, that's important.
If he gets $500,000, that's non-qualified money, like from the sale of a house, or it's from a bank account, or something like that, then he could get it with a step up in cost basis to where he has no tax ramifications. It's just here you go, free money. If it's an inherited IRA, then it's going to be federally taxable, and he's going to have to liquidate it over the next 10 years and pay federal income tax on all of it. Quite a different thing there. Mm-hmm. Margie, if it is an inherited Roth, if it goes directly from the Roth to an inherited Roth, then there's going to be an opportunity to either take all the money tax-free, or you can inherit a Roth and you can take all the money tax-free, or you can do a direct transfer into an inherited Roth, and then you have 10 years to grow the money tax-free after the passing of the person that left it to you. And then at the end of 10 years of tax-free growth in the Roth, then your husband will have to cash it out tax-free. But I think, under the way this is that Margie says this, looking for ideas what you would do. My husband's inheriting about $500,000. It is due to roll in over the next few months. That sounds like it's an estate where we're selling off houses and cars and stuff.
Yeah, it sounds like it's some sort of non-qualified account.
Yep, so we call it non-qualified because it's not a qualified retirement plan. If it's a qualified accounts, would be things like IRAs, 401ks, Roth IRAs, all this sort of thing, and they have kind of some different rules. The Roth accounts have the best tax treatment because you can put that money in an inherited Roth, grow it tax-free 10 more years, and then cash it out tax-free. Traditional IRAs, 401ks, those sorts of those employer plans, traditional IRAs and traditional employer plans like 401ks, 403bs, 457s, TSPs, those have a tax-deferred tax treatment, and under the Secure Act of 2019, those accounts you have to fully liquidate over a 10-year period. You have to pay federal income tax on all the money that comes out, and it can kick you up in tax bracket. Isn't that nice, Andre?
Oh, so nice.
Your parents or somebody leave you money, and then the IRS swipes it from you?
Yeah, well, they set the rules. They definitely know how to maximize their own pockets, the IRS.
For the benefit of the U.S. Treasury?
Yeah.
So then Margie said, we just need to park the money for several months until the dust settles with our lives right now. Whenever somebody wants to park money, there might be a reason. They have a liquidity issue. They need to have access to the money. A lot of times people park money, quote unquote. We've had people that say, oh yeah, I parked some money in cash because of 2008 scared me. I got out when the market fell. And then since 2008, they've been sitting in cash.
Yeah.
And so that can be, we don't want to do something out of like default or fear or procrastination or putting our head in the sand. Now, Andre, I peeked at the rest of this question here in just a minute while we're talking. So Margie says, we just need to park the money for several months until the dust settles in our lives right now. My husband begins cancer treatment soon, so that kind of changes things a little bit. Okay. Some information we didn't have. I didn't read the question before the podcast. We don't have a long-term plan for this money yet. Our heads are spinning. Well, with the cancer diagnosis, I bet they are. We don't and won't need this money to support us for the the rest of our lives. You don't need and won't need the money to support you for the rest of your lives. It's $500,000. It's a chunk, right? It's very fortunate, Margie, that you and your husband don't need the money to support yourselves. So Margie says again, Scott and Andre, where would you park it for several months or a year? Thank you for your time. You're welcome, Margie. So where would you park this $500,000 for several months or a year? But at the same time, you're telling me you don't need the money.
Yeah, it's a little contradicting. I mean, I almost feel like this needs to be like a two-part answer, one or the other version. Mm-hmm. It's, on a short-term basis, that's hard to, give you a good place without putting it at risk. Like
on the one hand, she's saying it's $500,000. It's important to write you about this for a question for the podcast. Right. It's $500,000. On the other hand, we don't need it.
Yeah.
On the other hand, hey, can I get it back in 6 to 12 months?
Yeah.
So it's a lot. It's a lot there, right? If you just want to park it somewhere for because you need it in 6 or 12 months, I'm not going to get mad at you if you do a high yield savings account, a number of things. But it sounds like you don't need this money now, and you're not going to need it to support yourselves in retirement. And I understand you're busy right now with your husband's cancer treatment, and I'm betting you he makes it. And what I don't want to have you do is regret that you didn't do much with the money over 6 or 12 months. Whoever left the money to your husband probably worked hard for it and saved it and did all this stuff, and probably thinks that this money ought to be, what's the word? You should be a good steward of the money. I know you got a lot going on right now, and you got a lot of things you're worried about. But I might take a long-term approach to it. You didn't tell us you want to buy a house. You didn't tell us you need it for medical bills. You didn't say you even need it for retirement. I might take a longer approach to this, and you can give us your ages either. But I'm thinking we might want to invest the money for the long term. Yeah. There's lots of ways to do that.
Yeah, I mean, if the last part of the question is they really don't need the money, I'm with you 100% long term. You don't need to take a lot of risk, but you can get a decent return. There's no guarantees, but you can get something that's not volatile. You don't have to get very risky in the investments. You can get something that's a bit more stable and consistent, and it throws off dividends or interest and whatnot. But if you're it doesn't make sense to put it into a CD if you need long term, because then you have reinvestment risk in the future. You don't know what interest rates are going to be. If you need it in 6 months, that might make sense. Otherwise, in this case, it seems like long-term is the better bet.
Yeah, and CDs are one of my least favorite, because this type of money, if it's non-qualified money, if it's not retirement account money, folks all the time put money in a CD, and then they say, well, yeah, I'll get the 12-month CD, and then they figure out they need the money in 6 months, and then to get out, there's an early withdrawal penalty. You're giving back the interest that you made. Or if you keep it in there for a year or two, yeah, you get bank interest, but now you got to pay federal income tax at ordinary income tax rates on the federal and to the state as well. Margie, if you're an Illinois resident, I don't know if you are or not. We're in Chicago, but we're federally licensed. We help people all across the country, but many states have an income tax, and like Illinois does. So if you did it in Illinois, you get bank interest, which is never as high as it ought to be, and then you got to pay federal income tax on the money, on the bank interest, and then you got to pay 4.95% to the state of Illinois on the money. So there's just, and I understand you're going through a lot right now, Margie. There are contradictions here. You guys are getting $500,000, but you don't need it. But you want to invest it, but you don't. So once you get in our phone calendar, we'd love to talk to you. Go to tuckerretirement.com. At tuckerretirement.com, you can see our phone calendar, and you can click and pick right there and schedule time with us, and we'll spend 15 minutes with you over the telephone the coming week. There's no cost, no obligation. It'd be good just to talk to you and get more of the story. And if you're listening to the podcast right now, if you have any question at all regarding anything financial, retirement planning kind of related type of thing, which is what that's why Margie wrote to us. She's just full of contradictions, right? The $500,000 I don't need.
Yeah, it's a little bit more detail, like age, maybe what they're planning. Use that money. What I thought
was interesting, among many things, but what I thought it was interesting, and Margie wrote to us for the Retirement Decoded podcast, and then said, "There's this $500,000 I don't need for retirement." Good problem to have, right?
Right.
How many people could use an extra $500,000 for retirement?
I'm available for adoption.
Who can use an extra $500,000 for retirement? I'm glad you don't need it. And I know what you're saying. Your husband's health is all you care about right now. At the same time, honor the person that left him the money and do something worthwhile with it. I don't mean that you should feel guilty about it. I don't mean go give it away. I mean, if you're going to inherit money, don't let inflation eat at it and not do the best thing for the money. So if somebody left you a house plant, you wouldn't put it in the basement and forget to water it, right? You would put it in a place of prominence, maybe a living room or a foyer or something. Make sure it got an adequate amount of sunlight. You might put one of those little fertilizer sticks in the soil. You'd probably water it once a week. Not enough water that you drown it. Not a lack of water to where it dries up and shrivels and dies. If you have inflation just eating at your money and you're not doing something proactive about that, I'm not trying to put you on a guilt trip, but you're not really honoring the legacy the person that left you the money was trying to leave. So that's a trip, isn't it? Poor lady, I'm picking on her and making her feel guilty.
But I mean, you make a great point about the inflation. It's, forgive me, I don't remember the exact months, but what was it, 2022, 2021, somewhere around there? We saw inflation at 9%, and it came out of nowhere. Inflation was pretty consistent up until then.
It kind of came out of nowhere.
Well,
it was like the tail end of COVID, and I forget the exact year, but there we were seeing, it was kind of funny, There were 2 stimulus bills in Congress during COVID, and then there was a third one.
Right.
And even as the third one's getting passed, we're kind of like, I don't know if we need this one too. Mm-hmm. And so we did that anyway and handed out more money. And then inflation goes up over 9%, and then the Fed just sits there like blinking and not doing anything. And we were like, oh my goodness. And then, kind of fortunately for a number of investors, is you could tell if inflation's 9%, the Fed will have to raise rates. And so a lot of folks were able to make some moves because the Fed was immobilized for like 6 months, which is kind of crazy.
Well, that's not, but that's kind of a one-off. How do you know that next time they'll be immobilized? How do you know next time the inflation doesn't go higher?
They might actually do their job.
They might, but they might wait longer next time too, right? So you don't know. But
goodness sakes.
But to your point, it's important to take care of that money because you never know when inflation can rear its ugly head and just start cutting your buying power in half. And then and by then it might be too late to really make those returns back.
Yeah, if you had that 9% inflation stick around for 8 years, it would cut the spending power of your cash in the bank in half. So say Margie, and that's a pretty extreme example, right? But you remember early 80s, or maybe you don't remember, you probably do, early 80s when inflation was like 20% or interest rates were. So say if you had that $500,000 at that 9% rate of inflation in 8 years, that $500,000 would only have the buying power of $250,000 today. So inflation is important. That's all we're saying. Get on our phone calendar at tuckerretirement.com, and we'd love to talk to you or anybody else and get your questions answered, your answers questioned. You've been listening to the Retirement Decoded podcast with Scott Tucker. I'm your host, Scott Tucker. We'll see you on the next episode.
Scott Tucker Solutions, Inc. has a strategic partnership with tax professionals and attorneys who can provide tax and or legal advice. Neither the firm nor its agents or representatives may give tax or legal advice. Individuals should consult with a qualified professional for guidance before making any purchasing decisions. A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. The views and opinions herein are those of Scott Tucker Solutions, Inc. and do not necessarily reflect the views and opinions of AE Wealth Management, LLC. Investment advisory services made available through AE Wealth Management, LLC. AEWM and Scott Tucker Solutions, Inc. are not affiliated companies. Insurance products are offered through the insurance business Scott Tucker Solutions, Inc. Scott Tucker Solutions, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Scott Tucker Solutions, Inc. are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Scott Tucker Solutions, Inc. is not permitted to offer, and no statement made during this podcast shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Scott Tucker Solutions, Inc.